This shocking dividend investing strategy will make you rich. Yeah, you heard it right. You don't have to be an investing genius to make a lot of money with stocks. Don't take my word for it. Just listen to what Warren Buffett, one of the greatest investors of all time, says. So what is Buffett's strategy that he thinks will make even a monkey rich? And what is the Warren Buffet's way of being insanely rich? Here, in this video, we are going to show you the famous Warren Buffett's monkey strategy. So before we dive into the video, hit subscribe for a front row so that you won't miss out on our interesting contents and be a part of our community. The Warren Buffett way distills Buffett's approach into 12 golden rules that have guided his investment philosophy. These rules offer valuable insights into the mind of a master investor, shedding light on the principles that underpin his remarkable success. 1. Simplicity and comprehensibility. The first rule underscores Buffett's preference for simplicity and understanding in business. He avoids companies with overly complex and technical operations, favoring those that can be easily comprehended. This principle reflects his belief in investing in what he knows, a foundational concept in his investment strategy. 2. Consistency in operating history. The second rule emphasizes the significance of a consistent operating history. Buffett gravitates towards businesses that have maintained a track record of selling similar products or services over the years. This predilection for stability and predictability aligns with his aversion to risky ventures and his penchant for long-term investments. 3. Franchise model and desirability. The franchise model takes center stage in the third rule. Buffett seeks businesses with desirable products or services without close substitutes and heavy government regulation. This criterion highlights his attraction to companies with competitive advantages that set them apart in their industries. 4. Wise capital allocation. Capital allocation takes the spotlight in the fourth rule. Buffett values companies whose management allocates capital judiciously, striving to maximize returns on newly invested funds. If a company's profits fail to improve with a new capital infusion, he advocates returning excess funds to investors through dividends, a testament to his commitment to shareholders' interests. 5. Adherence to fair accounting practices. The fifth rule extols the virtues of fair accounting practices. Buffett looks for companies managed by individuals who adhere to transparent and ethical accounting standards, reinforcing his commitment to integrity and sound financial reporting. 6. Honesty and intelligence. Honesty and intelligence form the bedrock of the sixth rule. Buffett values management that communicates decisions clearly to shareholders, irrespective of the outcomes. This emphasis on forthrightness underscores his belief that honest and intelligent leaders create a culture of trust and informed decision-making. 7. ROE over EPS. Buffett's focus on return on equity, ROE over earnings per share, EPS, becomes apparent in the seventh rule. He recognizes that ROE more significantly impacts investors in the long run, as it reveals a company's ability to generate returns on shareholders' equity. 8. Capital efficiency. The eighth rule delves into capital expenditures. Buffett prefers companies with limited ongoing capital requirements, favoring those that demand substantial initial investments but exhibit lower maintenance costs. This approach resonates with his interest in preserving capital and seeking efficient use of resources. 9. Low-cost operations and high-profit margins. High-profit margins and low-cost operations shape the ninth rule. Buffett values companies that derive profitability from core operations rather than relying on profits from miscellaneous asset investments. This underscores his preference for sustainable, intrinsic business value. 10. The $1 promise. The 10th rule introduces the concept of the $1 promise. Buffett requires that each dollar retained from earnings must generate at least $1 in market value over time. This principle underscores his emphasis on value creation and disciplined capital allocation. 11. Valuation through future cash flow. In the 11th rule, Buffett's valuation methodology takes center stage. He calculates the future cash flow of a business and discounts it using an appropriate interest rate to determine its intrinsic value. This approach reflects his meticulous analysis and rational decision-making process. 12. The margin of safety. The 12th rule, the cornerstone of his investment philosophy, encapsulates the notion of a margin of safety. Buffett seeks companies whose shares are priced below their intrinsic value, ensuring a cushion against potential market fluctuations. This cautious approach aligns with his aversion to unnecessary risk and preference for solid, long-term investments. That's it. Buffett did mention that the monkey should be patient and level-headed. In particular, he warned that the monkey shouldn't be tempted to make changes along the way. The legendary investor stated, "All that's required is the passage of time, an inner calm, ample diversification, and a minimization of transactions and fees." So what do you think of this 12-rule monkey strategy? Would you apply these for your next investment? Let us know in the comment section below.